Hey, gang. Welcome back to uh, the stuff about money they don't teach in school. I am your instructor, Dave Littlejohn. Today, as you can tell, a little bit different. I'm using my tablet, and we're going to try to do a screencast and talk about why diversification is not the whole story with investing. We talk about that a lot. You've heard probably the idea, hey, don't put all your eggs in one basket. That is true. Okay. It's not just about eggs in one basket. There's more to the story. And so I'm going to point some of this out today and show you why diversification isn't the only name in the game here. And we're going to talk a little bit about how do you build investment strategies, right? And so this is actually this is stuff that one day, if you're ever figuring out, maybe your parents may actually get a kick out of this more so than you. But hey, how do I set up my retirement plan? I mean, not like how do I open the account, but like what should I invest in? Well, I've said this many times. I don't get to give investment advice in these courses, okay? But we can talk about some of the ways things work. And what you're going to discover is, while I'm not telling you what to do, it may become really obvious that, like, well, you should do some of this stuff because duh. So that's what I want to do. Let's talk about some of the duh today. But I'm going to figure out how to share my screen first. So let's do this and share. And you can see, right, I'm holding my little stylus today. We want to see if we can get this to work. And I want to share the entire screen. So that'll work. And let's see if we can do a window. Yeah, let's Chrome tab, even better. Jamboard. We want to do this and share. So I trust by now you can see my little screen. And what we're going to talk about today is a little something that I call mind your shuns, right? But not shuns like, oh, I got to grab the stylus here, right? Not this kind of shun, right? No. We're talking about a different kind of shun. We're talking about the shun that ends in ION, right? As in diversification. Wow, that was okay, shun. Apparently I'm writing too quickly. There's diversification, but we also are going to talk about allocation, and we're going to talk about correlation. So with all of these, you'll notice, I guess they weren't, it should have been this TION, right? But you get the idea. Diversification, allocation, correlation. So what do they mean? Well, diversification is really simple. This is the egg analogy, right? If you can imagine, we've got our little basket here, and if all the eggs are in one basket and we drop the basket, we have a problem, don't we? Everything potentially collapses. And this is the idea of why they say we don't usually invest in a single stock, right? Here's a fun way to think about it. If a stock was a coin, right? So if you have a coin, then you can either have heads or tails. It's kind of like having a 50-50 shot at how something works out. But if you have two coins, then you have another heads or tails option, right? But between the two of them, you could have all heads. So that would be heads, heads. You could have heads, tails, but you could also have tails, heads, or tails, tails. So really what you have is, an option for two heads, an option for heads or tails times 2, or an option for 2 tails. Well, if the tails were bad, then what you have here is a 50-50 shot at messing it up, but only a 25% chance that you have bad outcome entirely, right? This is a split outcome. You get a 50% chance of a split outcome, 25% chance of both good, and 25% chance of both bad. And what happens is every time we add another coin to it, we make this mixture more complicated, right? So now you can get heads, 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 tails, 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 but you could also get heads, tails, tails. And so there's more combinations, right? And what it means is the probability that all three of them are bad at the same time goes down. And if you add another coin, you get the idea. We keep lowering the probability. So what diversification does is it makes it less likely that everything comes up bad at the same time. Now, this is a useful strategy because when we talk about diversification, what we're talking about is something called idiosyncratic risk, right? This is a funny word here. I hope I spell it right. Syncratic. Okay. Another way to put this is non-system. Now think about this, right? If you had a stock, okay, we used our egg example before. The reason that we diversify is because you can have something bad happen to one stock or one investment. One coin could be tails or heads, right? And so each of those coins that we had has its own individual risk. And so they are, in a sense, unrelated risks. And so let me give you an example. We have maybe a company like Boeing, which has a ticker symbol of BA, okay? And Boeing has some planes crash, okay? And as a result, Boeing, their stock goes down in value because they have bad news. Over here, we have a stock like Home Depot, okay? Home Depot doesn't get affected by Boeing airplanes crashing, right? So they are not related. So they are idiosyncratic and they are, as a result, independent. So when we diversify, what we're doing is we're separating out our risks from each other. But now let's talk about COVID-19. COVID-19 isn't a non-system risk. It's the whole system, isn't it? It's not idiosyncratic. It's everything. So it affected Boeing and Home Depot and everything else too, because it affects the whole system. So what we know then is diversification isn't going to help us for system risk. So we need to think about other ways to create less or to manage the risk when we can't just diversify away the risk. Okay. But before we talk about that, I want to make sure we understand that diversification just doesn't mean buy more than one thing, right? We think about diversification and we go back to our basket, right? You know, we had the basket with the eggs in it. And it's easy to say, well, that's good. What if, you know, as long as you don't drop the basket. But here's the issue. What if we have two different companies, I'll just abbreviate them. What if we have Home Depot on one side and then we have over here Lowe's? Now, I use this example a lot because in my hometown, they're like across the street from each other. And my question is, how different are these, right? I mean, Home Depot, they're both hardware stores. They sell lumber, home supplies. It's kind of the do-it-yourself home improvement store. And they're kind of the same store. I mean, they have different colors and they have some different things going on with their businesses. And let's be honest, right? I mean, actually, Home Depot stock has usually performed a little bit better than Lowe's. And there are some managerial reasons that may be true, but by and large, they're really similar companies. And so if something happens to the sector, right, the home sector, like let's say that housing, let's say interest rates go up, they kind of both get hit at the same time because they're subject to the same influences. And so what happens is, even though we are diversified, we don't get very much benefit of our diversification, right? So the problem is what we have is really high correlation, okay? And when things are really correlated, they kind of equal each other. They move together. They both move up at the same time, or they both move down at the same time. And that's a problem. So what we want to do is find ways, if we're really wanting to get the benefit, if we want, and I'm just going to abbreviate, diversification. If you want good diversification, then you need to make sure that you have very low correlation, because correlation kind of undoes the benefit of diversification. Now, correlation is usually measured in a ratio. So if you have 1-to-1 correlation, and then that means that if one of them goes up, they both go up at the same time. Okay, but if you have correlation that's maybe not 1-to-1, but it's more like 1-to-2, then your correlation is actually half. So you have less correlation. One goes up this much, the other goes up that much. And it's not, actually, I should correct this example because this is closer to what we would illustrate for a different term when it goes up. What I really should say is if they're 100% correlated, so we can scratch the ratios here, 100% correlated, they both move up at the same time. But if they're only 50% correlated, one of them may move up and the other one may or may not, right? And so if they are not closely related to each other, you get better diversification. So that's kind of the story of diversification that people miss a lot of the time is we want to have good diversification by having low correlation across the different things that we own. So not only are we, we putting the, we don't want all the same eggs in one basket, right? So it's like, don't put your eggs in one basket. Okay, well, let's not have the same basket too, though. So that's the low correlation concept. Now, the last one that we'll talk about is allocation, okay? And allocation is the way that we put these all together. Because if I have diversification and if I have low correlation, which is how my diversification works, right? So low correlation, diversification, then what we end up with at the end is different assets that we mix together. So you've probably seen, maybe you've seen this before, but people have seen a pie chart, right? And my favorite pie chart is this one, right? Where it says, this is the pie that I have eaten, and this is the pie that I'm still going to eat. Of course, ha ha ha, right? I'm hilarious, I get it. More importantly, when we talk about developing investments, we look at the pie chart and we realize that you can't, unless you're going to borrow money, right? Which I guess you could do. You say, well, I only have $100, but I'm going to go to a bank and I'm going to use somebody else's money too, and I'm going to borrow it. But if we're not borrowing money, we're just using our own, then we can say, I want to invest. And the first thing I want to do is figure out how to make a mix. And so maybe on one side, I want to do some stocks. And on the other side, I want to do some bonds. We've talked about both of these in other classes, right? And we know they're different, right? Stocks is equity ownership. So I actually own the companies. I have a part ownership stake. If they make a profit, I get a portion of it in my dividends. And if they go up in value, my stock goes up because I am an owner. And remember, the bond, I'm a loan guy. I'm making a loan to the company. They're borrowing money from me to grow, and they have to pay me back. And I am secured in the capital structure by my bond at a higher point than stocks, right? If the company goes out of business, I'm out of luck. My company's worth zero, and so I don't have any value to my stock. But my bond, if the company goes out of business, they can sell all the stuff the company owned, and whatever they recover, I might get something. So bonds are different, okay? What I have to decide is how much do I want in stocks and how much do I want in bonds, okay? So that's what allocation is really all about, is taking the different pieces and putting them together. If I'm a really aggressive investor, maybe I just want all stocks. But if I'm a more conservative investor, maybe I take and say, well, I want 75% in stocks and I want 25% in bonds. And what you can see is this is my allocation. 25% allocated to one category, 75% to another. And this can be split up in an infinite number of combinations. So there is no right or wrong answer to what is my perfect allocation. What we know is there's major asset types, right? So we can say, there's usually stocks, bonds, cash is one, and then what we will call alternatives, and they just sort of abbreviate these alts, okay? Within stocks, we have small, mid, large, value, growth, domestic, international, and then sector or other specialty, right? And so there's tons of different categories of stocks. And then bonds, we have differences of duration and credit quality and a host of others as well. Cash is pretty straightforward, believe it or not. Cash is like, well, it's cash or money market. So those are, and money market's kind of a form of cash. It's just got really a slightly different investment structure of really, really short-term bonds for money markets. But that's what cash is. It's just sort of a holding place. And in alternatives, you probably don't think about it, but lots of things that aren't stocks and bonds that are investments. You may live in one, right? Maybe a house, right? Which is another way of saying real estate. Okay. How about commodities, things like gold and silver, right? Maybe jewelry. What about oil, right? That's a commodity. What about funny things like cattle, right? Or land? So there are lots of other investment things that are not stocks, bonds, or cash that fall under the alternatives. And the trick to designing your investment strategy is that you want to have some in all of the categories and mix and match them together because they complement each other, right? So if you have some stocks and some bonds, sometimes you make more money than if you have just one or the other. So you mix them together and your allocation ends up looking like a very exotic pie chart with different weightings for different things, right? So you may have a few tiny pieces here, a couple of big chunks, some other specialties here, but you get a nice, pretty pie chart of the different things that you mix together. So that's the idea. Now, this one, if there's an interest, you guys tell me afterwards, hit me up in the comments and tell me if you'd like to learn more about this. But the question on allocation really is, there's an academic structure to this. And the question is, how much do I allocate to different categories? And the answer is it depends on your risk, but there's a funny thing, and it looks sort of like this, almost like an upside down Nike swoosh, and it's called the efficient frontier, right? I hope I spell this stuff right. Oops, that's going to be an F, right? The efficient frontier. And the idea is there is a perfect mix. So, what you have is, this is actually a graph. And here you have a graph of risk, and you have a graph of return. These are your charts, if you will. And so the higher the return that you get, the more risk you have to take. So I take this much risk. This is the biggest return I can get. If I'm only going to take this much risk, this is my return. If I want to take this much risk, I can either get here or here. But this would be stupid, right? Why would I bother to get down here? What I want is the most efficient mix I can get to, which is up here, because in theory, the efficient frontier is the highest investment return you can make for the amount of risk that you're willing to take. This stuff up here doesn't exist. This stuff down here exists, but why would you do it? Why would I invest here if I could take the same amount of risk and get that return? I wouldn't, right? So I want to invest on this magic line, but there is an optimized way to get there. There's actually a math formula for how to get there. It was built on a Nobel Prize winning theory. And the theory it's called modern portfolio theory. It's not that modern anymore. It was developed in the 1950s, but it's a concept called mean variance optimization. So if you've ever wondered, oh my gosh, why am I taking these dumb math classes? This seems so useless to me. The answer is, in the investment world, the math classes make sense here. If you're trying to figure out how to get the best sort of risk-adjusted return, like I want to make the best return possible, here's how I would do it academically. In practice, this curve moves around. Over time, it's not in the same place always, and so it will move. And so there's really no such thing as being perfect because we can't predict the future. But if we use data, it's been historically a pretty good methodology to get a lot of return for the amount of risk that you're taking. Again, there are no guarantees in the investment world, and you'll notice I haven't told you what to invest in or how or anything else. I'm just giving you the academics behind it, but that's what's going on. So now you have kind of a general concept of what are we talking about here? It's the efficient frontier. We talked about diversification, allocation, correlation, and hopefully that makes sense for everybody. So now that we've got that done, I hope that this has worked out well. I guess I'll go back and check the stream after the fact and see if we're able to pull it off, because sometimes I'm looking at the stream, sometimes I look at the camera. Maybe it's weird, but whatever the case, thank you guys as always for tuning in. Don't forget to do all the comment stuff or send us an email to info@littlejohnfs.com if you would like additional information, other topics, or if there's something that made you kind of go, I should look into that. Well, you know how to reach us. So until next time, this has been David Littlejohn. Thanks for tuning in. We'll catch you later.